Hi, I'm Pattu from freefincal. When investors want to select index funds, they start asking questions like which fund has the lowest expense ratio, which fund has the lowest tracking error, and so on. One of the biggest misconception is that a fund with the lowest tracking error will automatically have the lowest expense ratio. That is completely wrong. I have published a detailed report of the tracking errors of index funds, about 33 index funds, and this contains tracking error data over the last 3 months, 6 months, 9 months, 1, 2, 3, 4, 5, 6, 7 years, trailing with respect to April 30th, 2020. You can also get the last 12-month total expense ratio, the AUM as on March 2020, and so on. This Excel file is available for free. You can go to freefincal.com. You can see this post. Selecting index funds lowest expenses does not mean lowest tracking error, and you should be able to download the file at the bottom of the article. The download is free. You'll have to go to Instamojo to download it, but the download is free. Now, what is tracking error? Now, the tracking error is defined pretty much identical to how the standard deviation is defined. The standard deviation is defined as how much a monthly return deviates from the average monthly return over the last 1 year or 2 year or any given period. You can also say how much weekly returns deviate if you're going to take the average over weekly return. So that's the formula right here. So what they do is they find out the average monthly return, which is mu, and they find out individual monthly returns, which is xi, and they calculate xi minus mu the whole square. Sometimes a monthly return can be lower than the average monthly return. Sometimes the monthly return can be uh, higher than the average monthly return. So they take the square of the difference so that the plus or minus doesn't matter and you'll always get a positive sign, and they sum the squares and they take the average and then they take the square root of the whole thing. That's how the standard deviation is defined. The tracking error is defined in an identical manner. Only difference is they just find out the monthly return of the fund minus monthly return of the index, the whole squared, and then they calculate the average of it and take the square root of it. Now, the point is that the tracking error is dependent on the time over which you calculate. Most people don't understand this. Somebody started a fight with me saying, you have calculated a tracking error, that value is this number, whereas the value in fact sheet is that number, that place is this number, and so on. Yeah, if that place takes a 3-year tracking error and I have calculated 2-year tracking error, the numbers will be different. So tracking error is identical to standard deviation. Higher the tracking error, more the deviation from the benchmark. The problem with the tracking error is it does not penalize a fund for getting more return than the benchmark, than the benchmark index, because sometimes because of the AUM inflow and the outflow, your fund can get higher return than the benchmark index, because they will have some cash holding, and that cash holding, they will be some of it can be in some certificate of deposits and so on. Sometimes if the certificate of deposits give more return, then the fund may beat the benchmark. The index fund may beat the benchmark, and the standard deviation does not penalize the fund for such positive deviations, because see, because there is an expense ratio continuously being deducted from the NAV, there is no way a properly managed index fund can get a better return than the index itself. So if it happens, that means there's a problem with the AUM. Sometimes large AUM can result in deviations. That is, large AUM that comes in can cause problems. Large AUM that goes out can also cause problems. So you cannot assume redemptions alone will cause problems, mass redemptions. So all such problems are there. So in an open-ended index fund, it is not just the expense ratio that matters. There are other problems with respect to dividends. The company may have a stock split. They can have a buyback. All sort of problems. All these will take time to get reflected into the fund, and therefore they will cause a tracking error. So my suggestion is, investors should not focus on, retail investors should not focus on tracking error. Tracking error is a portfolio management problem, and you should leave it to portfolio managers. Index investors should compare the last 1 year, 3 year, 5 year trailing return that they get standard on any website. They should use that as a tracking error. How much the fund's return has deviated from the benchmark's return. Now, I have not included ETFs here. I'm coming up with a kind of a comprehensive report which will include ETFs as well. The thing is that in an ETF, they make a big mistake of calculating tracking error with respect to the NAV of the ETF. That is nonsense, because for an investor, the ETF price only matters and the tracking error should be with respect to the price. That's why I keep saying NAV tracking error for ETF is for portfolio manager. Uh, Price tracking error is for the investor, and as far as I know, nobody calculates tracking error with respect to price. And I want to change this. When I come up with a much more comprehensive report, I will be doing that. For the moment, it's the indexes. And if you go to this report, I'll just give you some data. The rest of it you can see from the file. This is the tracking error from May 1st, 2019 to April 30th, 2020. So that's the last 1 year. And IDBI Nifty index has got the lowest tracking error of 0.160. Of course, the top 5 funds, there's not much difference. Next comes HDFC index, ICICI index, LIC index, only then UTI index. The problem is IDBI Nifty index fund has got the ninth lowest expense ratio. It is not the lowest. That fund has got does not have the lowest expense ratio. It is the ninth lowest. HDFC has got the first low is the lowest. I mean, the expense ratio of HDFC Sensex index fund is the lowest, and ICICI Pru Nifty index has got the fourth lowest expense ratio. LIC Nifty index has got the 20th lowest expense ratio. So I have calculated the TER has been sorry, excuse me. Let me. This must have the TER. So this is the average 1 year. So this is the average of the last 1 year monthly TER. So you can see HDFC Sensex index fund has got the lowest TER, UTI has got the lowest TER, and so on and so on. But that doesn't mean they correspond to the lowest tracking error. So this is a big misconception that if you just simply choose the lowest, the fund with the lowest expense ratio, you will get the lowest tracking error. That is wrong. Of course, yes, having a low expense ratio and decent AUM is more or less enough to get a reasonable tracking error and within the top 10 or top 5, something like that. But you don't expect your fund to be the having the fund with the lowest tracking error. That's a misconception. You can how to choose an index fund. First of all, don't choose. I have explained this here in the post. I'll just quickly go through that. So how should investors select index funds? Stay away from ETFs. Recognize that indices like Nifty Next 50, Mid Cap Index, Small Cap Index, Banking Index, or any other index will have a higher tracking error. So you cannot compare the tracking error of all the others with Nifty and Sensex kind of index funds. My suggestion is stick to Nifty, Sensex, Nifty Next 50 and Nifty 100 index funds alone. Stay away from all the others. Get rid of this obsession to select the best index fund. This is just annoying, and such people cannot be successful passive investors, because you have to understand everything changes. Tracking error will change, expenses will change, AUM will change. You just can't say I'm going to analyze and find the best index fund. No, it won't work like that. So please look for a fund with reasonable AUM, reasonably low expenses, reasonably low tracking error, and just have 2-3 funds as a short list. Do inky pinky ponky, get on with it. So don't overthink the whole problem. You can see the full list of do's and don'ts here. I have also written about how to use the tracking error. So go to freefincal.com, go to the latest post on the tracking error. If you scroll down, you should be able to download the data for free via InstaMojo. So thank you for listening. Bye-bye.